Well, hey there, everyone. Happy Tuesday, February 3rd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully wintry Cleveland, Ohio. Hope you guys are all doing well, hanging in there. Thanks for hanging with me as I travel around the northeastern quadrant of the U.S. With some family here this week. Great to be debriefing on the market conditions today, which were not great. A nice afternoon rally kind of saved things from looking really ugly, but the damage was done through the course of the day. Cryptocurrencies, particularly Bitcoin, going big time risk off. We're seeing some decent bounces in the precious metals with gold and silver recovering, holding above that key trend line that we talked about previously. But the real story is with growthy stuff, not looking so growthy here, with continued rotation away from growthy sectors into value sectors with some, I think notable exceptions. But generally, we're seeing strength in the value sectors like materials, energy, industrials. Today, we're going to talk about what happened through the course of Tuesday's session. We're going to focus on some of the themes we're seeing at the stock and sector level. Breadth conditions, honestly, we're not going to talk about a ton because the short answer is the breadth is still fine. So there are a lot of, there are plenty of market tops. And again, no guarantee that we're in one at the moment, because there's still plenty more that we would need to see to be really, clearly negative on what's happening. But from a trend perspective, one of the common signals you get at a major market top is a deterioration in market breadth. You'll often get that before a top as, sort of the average stock starts to break down and just enough of the big kind of blue chip names are holding up enough that the major indexes still look pretty good. We're not seeing that here. We're seeing the market rotate lower because of the weakness in mega cap growth. Stocks like Palantir no longer in primary uptrends. Stocks like Meta gapping higher and rotating lower. Stocks like Microsoft just flat out breaking down and not holding anticipated support. And that weakness in growth, even though a lot of value stocks look quite good right now, it's enough to make the major averages go down. So we have to remember, as much as it's a market of stocks, our benchmarks, the S&P and the Nasdaq, are very growth tilted, which means if growth's struggling, the S&P and the Nasdaq are going to look a lot worse than kind of the market is doing as measured by individual stocks. I hope you'll see what I mean as we go through some of the evidence here today. But let's get into some charts. As always, we'll talk about a market recap. We'll look at the performance of the major equity averages along with other asset classes here today. We'll go through some other asset classes as well: currencies, commodities, fixed income instruments. We'll then look at the heat map, where we look at leadership themes in today's session. And then we'll look at some charts. And as always, our goal with the show is to update you on what's happened today, but try to connect that into more of the long-term trend, right? As a position trader, I still pay attention to what's happening every day, not like I'm day trading, not like I'm necessarily swing trading as my primary trading approach, but what happens in the short term. This is additional incremental evidence that we're using to gather and better understand how the broader picture is evolving. Long-term shifts always start as short-term shifts. So we can focus on those short-term trends, really think about what a longer-term move might mean. That's where we can get ahead of some of these unpredictable moves in the markets. All right, let's talk about the averages here today. The S&P 500, as I mentioned, by around 2 p.m. Eastern, things looking pretty dire. It dipped below 68.70. This is a far cry from 69.90, which is basically where we opened today. But the last 2 hours of trading, nice upside recovery, enough to push the S&P back up above 6,900 for the close, but still down about 0.8% for the day. The Nasdaq Composite even worse, finishing down 1.4%. The Dow was slightly lower, as was the small cap index, and the mid cap index, the only one of these major indexes actually finishing in the green. So that nice sort of late 2-hour rally pushed the mid cap stocks basically back to flat for the day, even though the S&P and the Nasdaq were down. Now, the only thing really in the green today is the volatility, right? The VIX did briefly go above 20, which is our kind of line in the sand level, or our red flag level, whatever you want to call it. Yesterday, we finished the day in a 16 handle, went up about 4 full points to almost touch 20.5 around that today's low around 2 p.m. Eastern. Afternoon with the rally in stock prices did bring volatility back down. So the VIX finished right at 18. That's still up about 1.7 VIX points. And that's not great, right? So a close above 20, we start pushing above 20. that's where we want to start to be concerned. But certainly grabbing my attention, I think it should grab yours as well. With all of that movement in equities, bond market's relatively quiet. You can see the 10-year yield kind of hovered right around 427, did get up to 4.3%, but essentially finished right at yesterday's close. The bond ETF we tracked, the TLT, had a nice afternoon rally to get up about 0.25%, and the dollar actually weakening a bit, coming down after yesterday's bounce higher. Green on the page of commodities, gold and silver, both having a nice gap higher at the open and holding those gains through the course of the day. Both of those up just over 6%. Copper prices up with the CPER up about 4.5%. Crude oil prices, natural gas prices all doing quite well. The energy sector, as you'll see in a moment, the top performing sector out of the 11. Strength in commodities. Good to see you. Good to have you back, fellows. All right, let's look at the cryptocurrency space. Bitcoin down 2.8%. Now it was down all just below 73,000 earlier in the day as equities were bottoming out in the afternoon. Bitcoin got all the way down to 73,000. Currently trading just above 76,000, right around 76,500. Ethereum prices right around 2,300. Now those are both down a couple percent from where we were yesterday afternoon when we did the show. But a big rotation lower through the morning and early afternoon of the equity trading session. Cryptocurrencies continue to go pretty risk off. We talked about the chart of Bitcoin yesterday. I would say at this point in a primary downtrend, we're not holding support. We're making lower lows and lower highs. That's generally bearish. The only thing is, do we see buyers coming in now that we're testing those lows from April of last year? I'm not seeing that sort of buying power really enter into the market. We'll see if we can recover like up to 80,000. That would be an encouraging short-term rotation. But for now, certainly looking risk off according to our work. Here's the 11 S&P sectors. You can see it was basically half and half. The energy sector, by far the best. The XLE was up 3.2%. We've had a lot of energy earnings in the last week or two with Exxon and Chevron last week, ConocoPhillips, if I remember right, this week, and some others randomly peppered around there. But strength in crude oil prices really starting to change the picture, and the energy sector really getting it done today. The materials sector, number 2, up 2.1%, and one of the more defensive sectors, consumer staples, number 3, up 1.6%. On the downside, technology, communication services, your 2 worst performing sector. Tech was down over 2% as measured by the XLK. The XLC, which is communication services, down 1.6%. Both of those sectors have some chart challenge names right about now. And it goes from like the Palantir kind of charts, which we featured earlier this week, trading below their 200-day moving average. It's Microsoft, just flat out breaking down and not holding support. Microsoft at one point looked like one of those great, slow and steady growth names. It just felt like it was going to be always going up. Not anymore, and you're seeing that rotate down pretty well. In the communication services sector, I would argue Meta featuring a gap and fail pattern. That's when you have a gap higher, but then just no buyers materialize. I'll show you most of those charts that I just mentioned when we get to the chart review portion of the show, because I think they all deserve our attention here. All right, what else can I tell you? The market trend model's getting pretty noisy right about now because this choppy week is causing the short-term models to kind of flip above and below the zero line. That's not updated. The widget here on stock charts, not yet updated for Tuesday's close. But when it is, I think you'll probably see a couple of those rotate bearish in the short-term model. As a friendly reminder, that market trend model for me is a weekly exercise. I really only evaluate changes in the model every Friday after the close. So any updates midweek are just placeholders, just letting us know that something might be changing going into Friday's close. A lot of game left through the course of this week, 3 more sessions. Breadth was actually pretty good for a very risk-off day, for a day that looked incredibly negative around 2 p.m. Eastern and just slightly less terribly negative by the equity market close. Remember that the breadth was actually pretty good. And this is one of those counterintuitive moments when the indexes are doing one thing, but the breadth is doing something different. I think this speaks to how big of a weight these growth sectors are. And when tech and communication services are down a lot and energy and industrials are up a lot, those aren't equal weights, right? The growthy sectors are just bigger and heavier, and they're going to weigh the major indexes down. So the breadth was fine. It was actually pretty decent, right? On the New York Composite Index, 54% advancers. On the mid-cap index, 59%. Look at the breadth in the Nasdaq, though. only 41% advances. So this is very much a growth struggle kind of day and not a uh-oh, everything's going down kind of day. But when you look at mega cap growth leadership, what we call the Magnificent Seven and Friends, a lot of red here. Tesla actually managed to be flat for the day, and that's as good as it got. Apple down slightly. Alphabet down just over 1%. But look at the worst performers. Broadcom down over 3%, as was Netflix. Now, Netflix has been a bad chart for a while. I don't think that's much of a surprise. Broadcom, though, testing some major league support. Microsoft failing already to hold their support, down another 2.9%. NVIDIA still, above a neckline on what we call the complex head and shoulders potential pattern, but down another 2.8%. So I would say the story here was the real deterioration in growth stocks, and we're going to see that as a consistent theme through our discussion today. All right, next we're going to look at the heat map here on stock charts, what's called the market carpet function. As a reminder, we welcome your questions. We're planning an all mailbag episode on Friday of this week, and we love to answer one of your questions on the show. Please use the comment section on our YouTube channel to share questions. We'd love to hear from you. Hope to answer one of your questions on that next mailbag episode. All right, looking at the technology sector in the upper left. I mean, your eyes have to be drawn to that because I know they are too for me. Boy, big red boxes there. Apple, an outlier, actually being flat today. Palantir and Cisco actually going up today, which is pretty impressive. Both up over 3%. Cisco making a new all-time high today. Palantir bouncing after yesterday's absolute bloodbath, up about 6.9%, but still, I mean, a concerning chart with that move below the 200-day moving average. But the rest of the top 10 stocks all down, and some of these in a pretty big way. NVIDIA, Microsoft, Broadcom, Micron, Oracle, LRCX, IBM, KLAC, Applied Materials. I mean, both down about 3+%, generally speaking there. And you can see most of the S&P 500 technology stocks were down. This was a big down day for tech and communication services. A lot of those names were down as well. Alphabet was one of the better performers, down just over 1%, but real deterioration elsewhere, except for kind of the other part of communication services. AT&T making a new 3-month high today. Verizon making a new 3-month high, indeed a new 52-week high today. T-Mobile bouncing off of a new 52-week low from January. So some of the internet kind of names, non-cloud names, doing pretty well, but the sort of the technology related names in communication services all struggling. We haven't talked a lot about financials, but I would just point out a lot of these names are struggling quite a bit. I mean, Blackstone is a great example to review because this is a stock that was just dominant in sort of the summer. Fourth quarter of last year had a big drawdown and it bottomed out around 135, 136 in mid-November, and then recovered above the 200-day moving average. And this is actually a pretty constructive pattern, I would argue, from a technical perspective, getting back above the 200-day. Look at these times when we hold it. So I often talk about a nice, bounce higher when we regain the 200-day. I always say, like, do we gain a foothold? Like, do we hold it above there? And for me, once we push above the 200-day, if you're like buying that kind of breakout, I think the 200-day has to be that stop, right? It has to be that initial level that you watch. And as long as we hold the 200-day, things are okay. But if we fail to hold the 200-day, that's a problem. It's about a week and a half ago that Blackstone finally closed back below the 200-day moving average. And the next week has been worse and worse. And today we finally undercut that November low to create a new 3-month low, which is one of the danger screens that I run, stocks making a new 3-month low. So with all of those stocks and groups struggling, what looked good? Industrials, generally quite positive. Random exceptions to that rule, but generally pretty good charts, right? John Deere made a new 52-week high today. GE Vernova made a new 52-week high today. Union Pacific making a new 3-month high today. So you're seeing nice recovery in a lot of those industrial names, and some of these that have been strong for a little while now. So while technology was strong and now looking weaker, a lot of industrials have been looking strong, continue to show strength. Consumer staples, here's Walmart in a primary uptrend off of the April low, making a new all-time high today. In the energy sector, ExxonMobil in a primary uptrend, making new all-time highs today. In the utility sector, NextEra Energy, one of those sort of renewable energy names, NEE, making a new all-time high today. So, stocks in these non-growth sectors are actually looking quite strong here. So don't see the S&P and the Nasdaq on a day like this and think this was a rough day for stocks. It was a rough day for the wrong kind of stocks, and it was a great day for some other names. And I think that's what you want to focus on here. That's one of my key takeaways. I think that's it. Again, the heat map like this is really helpful. When I'm back in the home office and I've got plenty of monitors to work with, I love to have something like this on one of those monitors just to keep an eye on market conditions as they evolve. All right, take a moment, if you could, like the video. We appreciate it greatly. Go ahead and tell a couple thousand of your friends about what we do here. Would love that as well. But especially, please take a moment to drop a question in the comments section of our YouTube channel. We'd love to hear that. Here's the S&P 500. Hard to tell on this chart, but we did remain in the green light section, although we did dip down below the 50-day moving average just briefly. That's actually happened a couple times in the last couple months. Each one of those previous times has led to a short-term bounce. We'll see if that plays out. The fact that we didn't close below the 50-day is encouraging, but we did break slightly below it. Today's candle, do you know, right? Quiz of the day, right? What is a candle pattern? We have a big up day and a big down day. Bonus question, what is that called in the bar chart vernacular? So what's the candle chart term for this two candle pattern? What is a bar chart name for this two candle pattern? So the bar chart one will go first. It's called a bearish outside day. That's when you're looking at a bar chart, you have an up day and a down day. Day two's range is wider. You have an up close and then a down close. And that wider range is why it's called a bearish outside day, right? So think of it as day one is a big move higher. We kind of open higher but close lower. So that implies a rotation. Suggests the next 1 to 3 bars are negative. So not a good sign for the S&P. Again, I apologize. I didn't bring the trumpet. Maybe if I had, we would have blown above 7,000. You can blame me if you're looking for a scapegoat as to why we haven't gone higher. But the weaker bar chart pattern today tells me expect further weakness. In terms of candle charts, I tell you what, I'm going to bring up the SPY just to see what that looks like on the candle chart. Yeah, so it's kind of, I guess you would call this on the SPY, you got to call this a bearish engulfing pattern. I was just looking to see if the close was below yesterday's open. It looks like we just did that. So big up candle, big down candle. Day two engulfs the open to close range, or what's called the real body on a candle chart. So up day, down day, that's called a bearish engulfing pattern. We haven't had a lot of these on the chart of the S&P 500. As a matter of fact, I can't remember the last time we had a bearish engulfing pattern on the S&P, but it's not good. That implies the rest of this week really more in a position of weakness, and implies that the market's on its heels and expect more weakness as we go through. Again, we're in the middle of earnings season, so anything can happen in the next couple of days. We got a lot of big names reporting, but the price is telling you what the price is telling you. So again, for now, as we've been sort of hovering just below 7,000, the momentum has been remarkably weak. So barring a big move higher on strong upside momentum, I think this is a market showing signs of internal weakness. Now I'm looking at the VIX here on our next chart on an open high-low close basis, just to show you these little intraday swings. 3 of the last 4 trading days, we've traded at or above a 20 level on the VIX. On a closing basis, we haven't gotten above there, right? We haven't really closed above 18 in the last couple of days. So we've had the VIX push above 20 or right at 20, but then finish below there. And so I tells you that the VIX is just teasing that danger zone above 20. And I think this is an important chart to watch here, because the options market tends to be pretty good when investors get nervous. The options market basically fluctuates to the degree that the VIX pushes higher, and that is the S&P index options are implying greater percentage swings in the underlying, in the S&P 500 itself. So watch for that VIX to push above 20. It's not quite there, but it's hovering right at that red flag level. I think this is a concerning chart here. We shared this chart on the show yesterday. This is the chart of the GLD, and I drew this big, thick red trend line just as a way to sort of show how what happened. There are different ways you can think about a market that went exponential, and we saw that with gold and silver and other metals just accelerating higher into the last week in January. And last week we saw this big downside reversal Thursday and then Friday. Here's yesterday's session. Today we're finally getting an up close. and a bit of a pause, at least in this downtrend. But this trend line could be a really meaningful way of just recognizing how a normal uptrend turned into an exponential rise, and now it's kind of come back to earth. And even though that's a huge rally and a huge drawdown, it's still kind of within the realm of a very consistent, very believable uptrend phase. So overall, I would say the chart of gold is still okay, right? Until that starts to break down. We'll keep an eye on that through the course of this week. Hard to imagine if equities go risk off through the remainder of this week that gold and silver wouldn't appreciate. That's a safe bet if there is one of those. You see the value of as a safe haven here, given the uncertainty in equities. I just want to highlight 4 of the S&P sectors doing quite well here on a relative basis. I recorded the monthly chart review for my market misbehavior premium members. As a reminder, the premium membership, if you like what we do here on the show, the next step with working with me and getting a little more hands-on attention and behind the scenes looks at how we do our routines, what kind of key investment takeaways we're finding as we review charts every day, every week, every month. That's what our premium memberships are for. It includes member-only reports like our monthly chart review. It includes virtual courses, access to a member community where you can ask questions and chat with other like-minded investors. But I just did the monthly chart review that only went out to my premium members earlier today. One of the things we do is apply our market trend model to different sectors and actually look at sector relative strength through the lens of that proprietary market trend model that I use, in looking at the major asset classes as well. And we surfaced 4 sectors showing, the most strength, really, or the most impressive returns in January. And 3 of these are very value-oriented, the MEI sectors. From the top, you have industrials, materials, and energy. And each of these lines represents the relative performance. So the lines going up means they're outperforming the S&P. At the bottom, we have the consumer staples sector, right, which is one of the more defensive sectors, but really starting to improve. We highlighted charts like Walmart making new highs this week, right? So you're seeing strength in these sectors. And I think a consistent routine of focusing on relative performance can be so valuable. So I hope if you've been ignoring these sectors, here's your wake-up call to look for opportunities in sectors showing strength. If you're concerned about technology, find strength elsewhere. They're out there. There are plenty of stocks doing quite well. If you want more info on our premium memberships, by the way, go to marketmisbehavior.com/premium. Make sure you use the code YouTube when you check out. You get 30% off your first 12 months on any plan. What better day than today to become a premium member, upgrade your own routines in 2026. So while the S&P 500 featuring what I would call a bearish engulfing pattern, Alphabet featuring what I would probably call a dark cloud cover. This is a 2-bar pattern where you have a big up day, a big down day. The down day opens higher and closes at least 50% of the way through, which it just barely did. That's a dark cloud cover candle, suggesting similar to previous candle patterns we've highlighted. Next 1 to 3 bars, most likely lower. So while we could get a recovery the remainder of this week, the movement I'm seeing today in these growth-oriented areas of the market suggest weakness, not strength, through the remainder of this week. We'll continue to track that, of course. One of the more concerning charts I will share with you today is Meta. Meta had pretty good earnings last week. Remember that day last week. I think that was Tuesday after the close or Wednesday after the close, whenever it was, where Microsoft missed. Meta beat earnings. Meta gaps higher the next day. Microsoft gaps lower. Microsoft gapped lower and just keeps going down. I mean, it's been an ugly post-earnings reaction. Meta looked pretty good, right? A big gap higher, finally gapping above resistance. Things look pretty good. But here we have what I would call as a gap and fail pattern. When you have a gap higher and then the price fails, think about what this means. Last week after earnings, we revalued the stock from around 665 up to around 740 from one day to the next because of strong earnings. All right, we the stock deserves a higher valuation. Let's pay a little bit more, a higher price. Let's pay more for the earnings growth or the potential earnings growth. From there, though, no additional buyers have come in. What we want to see after a gap higher is a run further. Right? We want to see additional buyers that are willing to pay 740, 750, 760. That additional demand, that optimism for future earnings growth is what drives the prices higher. Investors have basically been cashing out, thrilled to finally have a gain in Meta. And so the stock gapped and is now failing lower. That's a bearish sign for Meta, and I think a bearish sign for growth in general. Broadcom, I had an alert set, which I highlighted for all of you. Broadcom below 320, I think, is a pretty ugly chart. We did it. We actually traded on an intraday basis all the way down to almost the 200-day moving average. It did close almost exactly at our level support. So I would say let's wait to see if we get downside follow through. This is not a great head and shoulders or even a complex head and shoulders. I wouldn't call it one of those patterns because there's no real symmetry. It doesn't really look like that kind of pattern. However, there's a very clear support level around 320, and that very clear support level potentially broken today. And we want to see what happens tomorrow because we did close right back up at that level, which implies maybe it's not quite broken yet. But I think, we've got the previous swing lows over the last 4 months. We have the Fibonacci level around 308. We have the 200-day moving average around 306. We failed to hold that confluence of support. All of a sudden, Broadcom in the semiconductor group looks like a pretty ugly chart. Palantir gapped higher today. That's great. It actually opened around 165. Here's the bad news. By the close, it had gone back below the 200-day moving average. So that gap higher met with selling today as Palantir rotated higher. This is an earnings name yesterday. Nice gap in the after hours. Nice gap higher at the open, but that open, that higher open was sold off through most of the day. It did recover a bit going into the close, but still below the 200-day moving average. You want to see a chart like that recover the 200-day, in my opinion. Microsoft now making enough of a deterioration. We've gapped lower on earnings after failing to break above the 200-day moving average. This week now we are failing to hold the last support. I'm fresh out of support levels, folks. I mean, if you look, we're looking back to the gap back here. We're now below the upper end of the gap. Microsoft is in a risk-off position. This is in a primary downtrend, guilty until proven innocent. So if all those charts look rough, what does not look so bad? 3 charts I'll share with you that should give you some renewed faith in the equity markets. They're out there. It's just not in the growthy stuff. GE Vernova is an industrial machinery name. This is part of that breakup in GE. We had GE Aerospace, GE Vernova, etc. This is more the industrial side of GE, making a new all-time high today. Look at this breakout above. Would you probably call it a bull flag pattern, I would say. But you have this nice break after testing the 50-day rotating higher, moving averages in proper order. That's a strong chart getting stronger. NextEra Energy is in the utility sector. It's one of those kind of green energy type of producers with wind and solar and all of that wrapped into one. Sort of chopping around here in the last week, but I like this break above the October and November peaks. If it can hold 86, I think this is a pretty good chart. And again, the moving averages in the proper order. And it's not all things that are just making new highs. ConAgra Brands is in the consumer staple sector. Charts like this are why the XLP is outperforming. Charts like this represent a shift from offense to defense. ConAgra Brands has been in a downtrend for over a year. Most of this chart has been going down and to the right. In the last month, we've seen an upside rotation. CAG closed above its 200-day moving average for the first time since October of 2024. That's how long this thing's been going down. It's overbought for the first time since September of 2024. So after being in a bearish momentum phase, we're finally breaking out on stronger momentum. Ugly chart becoming less ugly, and I would argue now potentially in a primary uptrend again. Folks, that'll do it for today. Thanks so much for joining me here on Chart This with Dave Keller. Thanks for being flexible and hanging with me as I travel around this week, doing some family things, but still following the markets and sharing with you charts as I can. Please take a moment and drop a question in the comments section on our YouTube channel. Don't forget to follow us on all the socials. We're on the Facebook. We're on YouTube, of course, where you can participate in our community. So make sure you subscribe to the YouTube channel, but also on LinkedIn. You can follow me there, on X, on Blue Sky. Happy to share charts and ideas with you at all times. For now, I'll say have a great night. Remember, it's always a good time to own good charts. Take care, folks.